Good afternoon, everyone. I am Bonnie Sussman, partner in the Financial Services Group at Eisner Amper. I am pleased to introduce today's panel, This Way Up, How Alternatives Should Look to Reorient in Q4 and Beyond. Today's panel will discuss the ability to adapt to the changing world, and new traits such as emotional intelligence will come into play much more. If you would like to submit questions to the speakers, please use the Q&A widget, which will also direct you to live tech support.
Welcome. My name is Bradley Sachs. I'm a reporter at Business Insider who covers hedge funds and finance. I thank you for joining Eisner Amper's panel this afternoon. Right now, we are joined by a great threesome of panelists. First off, we have Terry LeCamp from Melody Capital. She's the Secretary of the Investment Committee and the Chair of the Valuation Committee. We also have Craig Bergstrom, the CIO of Corbin Capital, and Nancy Davis, the founder and CIO of Quadratic Capital. The first question that we'll jump into right now is, what have the winning strategies been in the alternative world during this pandemic? We're 6 months into it, and we're trying to find out which strategies exactly made the most sense for investors during this time. Craig, if you could start us off.
I think what's been most striking is the level of dispersion across strategies this year and within strategies. So we see that generally credit strategies have been the laggard, structured credit performing, particularly poorly, while equity strategies by and large have done quite a bit better, although U.S. equity strategies generally better than most non-U.S. equity strategies, and tech certainly the winner. Macro, I think we've seen a pretty wide range of outcomes as we've seen sort of internal in the other strategies as well. So I think what we've seen is volatility, no doubt about that, and pretty high dispersion at the asset level, at the fund level, and at the strategy level.
Thank you, Craig. And Craig, of course, mentioned volatility, and we have an expert on that subject on the panel. So Nancy, I'd love to hear about how you guys have handled volatility at Quadratic during the pandemic.
So our strategy is long volatility. So a lot of times people hear the word volatility and they think of it as a negative. But if you own it as an asset class, it's a nice diversifier. We were one of the few strategies that did have positive performance in the month of March, and have also continued. We had positive first quarter, second, and third quarter so far. So it's volatility can be your friend as well, especially what we invest in at my firm is interest rate volatility. And in the history of financial markets, it's really trading near its all-time lows since the data started in the late 80s. So it's a pretty compelling asset class, I think, to own as a diversifier.
Thank you, Nancy. And now for a somewhat different take on the alternative markets than we've already heard, I'd love to throw it over to you, Terry. Could you walk us through what Melody does and what you guys have been able to see in the 6 months that have passed?
Thanks, Bradley. Yes, Melody Capital Partners is a direct lending fund. We invest in private bespoke lending instruments via a hedge fund, a hybrid hedge fund, as well as private equity vehicles. We have experienced some market volatility, but our lending strategies in the 4 sectors that we participate in have gone down in Q2, but have recovered for the most part over the last couple of months as the markets have improved. I would say with the exception of our energy book, which is somewhat COVID dependent because of the demand side of the equation, but was really hit by the Saudi and the Russia oil debates. And so we have still not seen a recovery in that book. On the real estate side, where we also participate, we've seen strength in the non-metro real estate markets. The areas of challenge in the real estate business have been in the hospitality sector and in the metropolitan commercial real estate sector. So this is the time when you dust off your downside cases and in your credit committees. And I think loan to values have been more challenging, but collateral values have been impacted. But if you've planned for your downside case, and I think we've done a good job, particularly in real estate and financial institutions, we have seen recoveries back to pre-COVID levels.
Thank you, Terry. And working off of that, what changes have your firms made in the 6 months, and which ones do you expect to be more longer term, especially once the pandemic has passed? Terry, if we could go back to you real quick.
Yeah, a lot has changed. I think trying to parse through the short-term impacts of COVID and the long-term impacts are the biggest challenge and create the biggest opportunities. Clearly, using technology, particularly not just video conferencing, which everybody's been forced to do, but what are the long-term opportunities with the changes, the social and technology changes that we all see, mobility and where people are working. We have an office in New York City, and we still really don't have the need or demand from our employee base to go back to the office. And I think that's true of many of our peers. So that has a long-term impact for our business on the steady state side, on the non-growth side. It's pretty easy to work from home, but it's much more challenging in our new business initiatives to grow teams and processes remotely. So I think that's where we really need to be smarter. And in Q1 and Q2, I expect that we will be fully back in an office environment, rotating, yes. So on the LP side, I would say the S in ESG trends is going to be more important. We're seeing on the fundraising side, the social responsibility and diversity questionnaires coming in. And I think especially with European investors, we're going to see that be more of a mandate than we have in the past. And even with US investors, I think the social metrics, not only on the investing side, but on the manager side, will be more important.
Thank you, Terry. Now, Nancy, if we could get into some of the changes that have happened at Quadratic during these 6 months, and any of them you expect to last longer than this pandemic.
So Bradley, it's a great question. We definitely see the pandemic accelerating a lot of the trends that were undercurrents in the market to begin with, but now they're really taking center stage. And we do think inflation was an undercurrent that was really out of consensus and underappreciated before the pandemic. But we think now, with the combination of fiscal spending and the Fed really not thinking about raising rates, and the entire market has thought of the pandemic as deflationary, it's a really unique opportunity and a trend that we're seeing. The latest CPI data was much higher than expected. Things like used car sales were at the highs over the last 50 years. And I think one thing that all institutional investor portfolios they're not prepared for a stagflationary outcome, which in stagflation, that would be when stocks and bonds trade off together. And so we think we've definitely seen a lot of interest from institutional investors looking for stagflation protection. And even if they don't think there's going to be inflation, it's definitely an underpriced asset, especially inflation expectations.
Thank you, Nancy. Now let's turn to you, Craig. Not only are what changes have happened at Corbin, but also with the managers you guys invest in. What are they telling you about the changes that they've made to their business?
So I would echo some of what both Terry and Nancy mentioned. From a business perspective, I think not a whole lot has changed for us. We've been operating remotely since early March, a few weeks before I think most organizations, and we expect to be likely through at least the end of the year. The one thing I would note about that is, our team has been together for a really long time. My 5 partners and I on the investment committee have been working together for upwards of 15 years. I think that's super helpful. I think it would be enormously challenging to try to onboard and train and acclimate new junior hires. So I think that's a real challenge for organizations that are, have a higher level of employee turnover, and one that I don't wish that we were addressing. From a portfolio perspective, I think, we relearned a lesson that I thought we were always sensitive to, going back before, even before the 2008 financial crisis, right? Which is how hazardous leverage can be. I think what was striking to me was how, for a brief period in March, even extremely low levels of leverage that I would have thought would have been absolutely defensible in just about any market environment, did still get people in trouble in the structured credit markets, for example, people running 130, 140% gross long, which even to severe stress cases of historic volatility would have been fine and created problems for people. I think that's a lesson, that a few people learned in a fatal fashion, right? There are, more than 2 or 3 structured credit managers that sort of went out of business in and around March. And I think that, for those who survived, that, that's a lesson that was reiterated as well. Although, again, not sure that the future will repeat that, right? As the saying goes, it rhymes more than it does repeat. I think it was, for equity strategies, a nice to see and fairly rare instance where we saw a reasonable number of hedge funds manage their gross and net exposures in a value additive way. So historically, over the last 20 years, when we've seen equity managers, respond to changing market conditions by, grossing up or grossing down or buying the dip, often that's value destructive, right? I think we saw that in 2011, for example. And this time, a reasonable number of managers were able to successfully use March as something of a buying opportunity, which is, I think, one of the reasons why equity performance year to date has been so strong. Although, on top of that, core stock selection has certainly been very good also.
Thank you, Craig. Now, let's touch on something that I think will be different for each of your respective fields. Would love to get into what valuations are looking like right now in your space. And Nancy, let's start with you, because I know you touched on how this is the cheapest it's ever been in your world.
So Bradley, your question's a good one. I think right now investors are struggling to find value in different asset classes. Obviously, the equity and the credit market have really recovered to their pre-pandemic levels, whereas other markets like the rates market is still trading in a very distressed environment. You can see that from the level of 10-year nominal bonds, currently at 67 basis points. That is definitely not a healthy looking 10-year. And I think the question remains is whether the equity and credit markets are right, that the recovery is underway, or whether the rates market is right, because their paths have completely deviated during the pandemic. So we do think investors should be positioned for diversification. I think one thing we saw in March was that many portfolios are short volatility. To Craig's point, structured credit managers have mortgages and agencies on a levered basis. And if we learned anything from the global financial crisis, it's that mortgages inherently are short volatility. When the price of volatility goes up, they lose money mathematically in terms of that mark to market. That's because the homeowner is long the option to prepay whenever they want. So some people call it a convexity correction, but I think everyone should really wake up that whether they know it or not, if they have mortgages in their portfolio anywhere, even with passive ETFs like the Barclays Ag Index, they are short volatility. And so it's a really important time to look for diversifying strategies, to use the month of March to say, look, credit and equities sold off together. What are things that had uncorrelated returns? And you don't want to necessarily have negatively correlated all the time, because you want to have a portfolio that's going to have a positive return. So I'm not a big fan of, tail hedging, but things like interest rate volatility, inflation expectations, those are trading near, if you go back to very few asset classes are trading below their 10-year averages. These are trading, call it below their 30-year averages, especially interest rate volatility. We think it's a really attractive time for investors to be looking for these value plays in the fixed income market to diversify credit and equity exposures.
Thank you, Nancy. That was a take that I think many viewers will appreciate. Terry, I'd like to throw that over to you, since you exist, I think, in a different space than many equity and credit managers. I'd love to hear what the valuations are looking like in your market and how you guys are thinking about that.
Yes, Brad, we are much less impacted by market moves. We saw in March, April, May, very significant gap outs in spreads on single B, triple C in the middle market, which have, for the most part, in the sectors we invest in, have come back, with the exception of energy I mentioned earlier. But most of our valuation assessments are related to idiosyncratic risk of our borrowers, and we're very much in a relationship business. And, PPP was important to many of our borrowers to get them over the hump of the shocks to the system. Our financial services, non-bank financial services book was really relatively not impacted by the COVID and economic slowdown. For the most part, our real estate book as well. In some cases, collateral values were enhanced. Except in the two areas, hospitality I mentioned, and in the metropolitan area lending we've done, there have been some challenges. But relationships are really still very key in our business as a lender. Being close to our borrowers is critical, and providing some relief if they're bumping up against covenants is very important. And being incredibly close to collateral values to monitor that loan to value. And having personal guarantees is actually proven to be quite important to make sure that our borrowers are aligned if we are getting closer on a loan to value basis, or collateral values have either longer term declined or maybe temporarily declined. I would add, and this is a trend that I see happening and will expand, I think, and is a long-term trend, is auctions, these online auction platforms for illiquid assets that have really exploded and given borrowers as well as lenders an avenue for liquidity that didn't exist before. So I think that is a long-term trend. To Nancy's point, some of these platforms and online technology trends have really accelerated in the retail space and now in the commercial real estate space. So we're quite pleased to see that, and I think it'll give a transparency and pricing discovery that we've never had before in some of these illiquid sectors, illiquid asset classes.
Thank you, Terry. And now to Craig, it's going to be framed, I think, a little bit differently than asking some of the other panelists, but we'd love to hear how you think about market valuations and working with the managers that you guys invest in, particularly the equity managers that you guys have in your portfolio.
So we don't spend a whole lot of time focused on high-level market valuation, right? I would sort of echo Nancy's general assessment, maybe framed a little bit differently than she did, that rate duration feels expensive to me. I've felt that way for a number of years, and this year I couldn't have been more wrong. What I would say with pretty high certainty that I think she would likely agree with is that the skew is not much in your favor, right? When you look at how much it can go against you versus how much you can make if rates go negative, that's not an upside downside that we find super attractive. I would say that that some parts of the credit markets we think still reflect a meaningful degree of distress. Some of that is unquestionably fundamental value destruction, but some of it is also technical pressure, right? So I think that that manifests itself in particular in the CLO market and the CMBS market, where we've seen, unquestionably some fundamental credit losses coming up through the bottom of the stack. But we do also think that there are interesting opportunities in those markets, given meaningful distress on behalf of on the part of the market participants, right? The investors in those markets, as opposed to just the assets. Equities, I think, again, is a little bit of a fool's errand. I frequently joke that predicting the short, medium-term path of equity prices is best done by strategists who aren't accountable for results, not by portfolio managers who are. But it has been nice to see, significant dispersion, which has produced opportunity for good security selection value add. So, so as of June 30, it was just in that 6-month period, one of the best years for equity security selection, stock selection that we've seen in many, many years. So, so if you think back 2 years ago, the press, the chatter was all the death of fundamental stock picking. The future is indexing and quants and bots. We took a somewhat contrarian view that there was still going to be good opportunities for fundamental stock selection. And it's nice to see that it's a strategy that worked, well in 2019 and again has worked well this year.
And Craig, if we could follow up on something you said there, you mentioned the death of the fundamental equity manager that might have been a little premature. Another death that might have been predicted a little too early was the death of the macro manager. We'd love to hear about how Corbin is thinking about the macro space and the macro managers that are out there, and how it's dealing with the current environment and pandemic.
I would say, Bradley, that the criticism of macro as a strategy was supported by perhaps more years of lackluster performance. If you look at traditional G3 or G7 macro as a strategy, it's been pretty underwhelming now for a pretty long period of time. Almost back to the GFC in 2008. We had a thesis, hard to prove, but that a lot of the struggles of traditional macro were driven by the extraordinary levels of policy intervention, from the big central banks, the Fed, the ECB, BOJ. So one of the things we did in response to that was to increase our focus on sort of macro managers trading in less traditional markets. One flavor of that was EM. That's generally been good the last kind of 5 years or so, but generally not so good so far in 2020, where EM has produced a lot more places and ways to lose, I think, than ways to make money generally. I think when we look, year to date more generally at macro, it's not an amazing story, but a more positive one with a lot of sort of classic macro managers, some of whose stars have faded a bit the last few years, have generally performed pretty well. Some others have struggled, but I would say that macro generally we sort of put in between. It's done better with a better average and more positive skew than we've seen out of credit managers, in particular better than structured credit, but generally has not done as well or produced as good a skew as equity managers have.
I'd like to ask you guys about something that I think is top of mind for a lot of people in the hedge fund and alternative manager universe, and that would be data usage. Specifically, how you guys use data to get ahead of some trends to make sure that you're at the top of your game. I'd love to turn it over to Terry to hear about how Melody uses data in formulating its investment theses.
Yeah, Bradley, data is absolutely critical, and I think many of us in the private equity world have done a little too much outsourcing of technology, and I think we all need to focus a lot more on integrative tools that will provide us with an edge. And so we've built proprietary data warehouses with specialized reporting so that we can manage all aspects of our business on a real-time basis. I think we lag our hedge fund counterparts in the private equity world in doing that because the velocity of our investing just hasn't driven that need. But I think to create a scalable platform, we've got to get off our 40-year kind of addiction to Excel, which just doesn't provide us with the immediacy of data and reporting and integrated information that we need. Our investment team needs it. Our back office needs it, and we've made certain investments and will continue to do so in order to create real-time integrated data so that we can make decisions not only for our investors but for our business partners.
That was really helpful and informative. Craig, I'd love to hear about how Corbin evaluates the data strategies of the managers that it invests with. Data's become such a big part of what hedge fund managers do. Would love to get a sense of how you guys think through and talk with them around data, alternative data, and everything that drives a good investment engine.
It's something that we've spent a fair amount of time thinking about and talking about the last kind of 4 or 5 years. But it's actually somewhat ancillary to our focus areas. So we're not generally big investors in, let's call it, AI or machine learning or a lot of the black box quant strategies, in part simply for the basic fundamental point that we're in the active management business, right? We're looking to create portfolios of hedge funds for institutions that can materially outperform on an after fee basis. And we historically have found it very hard for us to develop an alpha edge looking at those strategies. I would say I'm a little bit more broadly skeptical about the sort of long-term future viability of a lot of them as well. But that's not a deeply informed view. I would more just say that that our job is to develop an information edge, a research edge, that we can monetize for our investors, and we generally haven't felt that we could develop that superior understanding in a lot of these sort of very statistical or quantitative or black box kind of strategies. So we certainly spend a fair amount of time talking with fundamental investors about the way they harness and use that, but it's typically one input, right? It's, hey, as part of our research on this retailer, yes, of course, we look at, satellite car counts from the parking lot or cell phone location data. But it's one input, not the primary driver of most of the strategies and managers that we invest in.
Thank you, Craig. That's helpful to understand the difference, I guess, between what you look for and if you're a quant investor, where data might be the driving factor versus working with a fundamental manager. My last question that I've got written down here, and then we'll get to some audience questions, is around basically the future of an alternative asset manager, and really, after the year we've had, what skills they need to succeed in 2021 and in the coming decade. Terry, if you could take this one first, would love to get a sense of what an alternative manager needs to have in his or her tool belt going forward.
So in our world, as I mentioned earlier, we're in the relationship business. I think in 10, 15 years, direct lending and bilateral bespoke investing may be the only human-based strategy around. I think big data and technology is going to take over large parts, and already has large parts of the investment world. But I think there will be continued opportunities to do private direct lending and investing. So what I'm finding is that the skill set that we need to develop those relationships with borrowers and with potential investees, and work through difficult times like the one we've been through recently in 2009, is a very special set of skills, especially in credit. And so it's all about, as far as the investment side, it's all about the relationships that the people that we have. And it's very important to retain those people and manage and compensate them well and provide them with the flexibility they need to do what they need to do. So I think people management is critical. We have allowed all of our staff to work from home and will continue to do so as they see fit. On the business building side, that is a little more challenging, and we'll provide safe environments for them to get together in groups, not just on Zoom or Skype. And then, of course, there are so many opportunities in certain segments and sectors of our economy for companies that don't have access to capital in the larger capital markets. I think that has grown and will continue to grow. And so we're very optimistic about both direct lending and direct lending in our sectors, and telecommunications, infrastructure, and real estate, and non-bank financials.
Thank you, Terry. And Nancy, if you could take that same question, what skills does an alternative asset manager need in 2021?
So I think it really goes back to what does the client need? I think at the end of the day, all asset managers, if we operate with, our number one purpose in life is to do the right thing for clients and for their portfolios, that is the way to succeed in this business. And I think clients, especially institutional investors, have moved very far into private portfolios, whether it's private equity, private credit, various strategies that don't have liquidity. And I think liquidity is a key thing that many institutional investors should be thinking about, also having non-correlated strategies. So for me, I think most investors are looking for things that are a little bit different, but it's sometimes hard because many of the consultants and portfolios look kind of the same, right, with the same asset classes. So I think it's a challenging time for portfolio managers, for asset allocators, and thinking about the right asset allocation. And I would say, I think the pandemic has really, as Terry mentioned, emphasized the the S and the G in ESG strategies. And I think that's a great opportunity for more diverse managers. And I'm not necessarily talking about gender, race, sexuality, any of those diversifiers, but having a strategy that's not another Me Too strategy where they're taking an equity portfolio and slicing and dicing it, or taking a credit portfolio and slicing and dicing it. So I know, speaking from Quadratic's point of view and the iVol ETF, the pandemic has been, I think, a really terrific opportunity for us to point to things that are not correlated with stocks and bonds. And that's what investors need, right? They need diverse portfolios, because you don't want to take all your chips on one outcome. You need to have diversification, because nobody has a crystal ball about what's going to happen in the future. So I'm really excited about people looking for true alternatives. And I don't mean just private fund wrappers or higher fee strategies. I mean things that are different. And we're embracing it, loving it, and look forward to the rest of 2020 and beyond.
Thank you, Nancy. And Craig, same question to you. What skills does an asset manager, an alternative asset manager at that, need in 2021?
Just a few sort of observations about the general trends that we've seen in the alternative markets, right? I think there's been a huge shift towards closed-end structures, right? Away from open-ended hedge fund structures. In part because the businesses that manage those, historically sort of the private equity firms, have just done a much better job scaling. If you sort of think about the size of the biggest hedge funds 15 years ago in comparison with the biggest private equity firms, at the business level, the private equity firms are overwhelmingly the winners, right? The Blackstones, Apollos, Carlyles, are just quantums larger than the largest hedge funds now. I think, though, some of that is a somewhat commoditized version of exposures. Those are all obviously great organizations that deliver high quality offerings, and I think, to Nancy's point, offer something that clients really value. I do think that there are still opportunities for smaller, nichier things, differentiated, offering strategies in and around the giants. So I don't entirely buy into that view that the investment bankers would have you, believe that the future is giant index shops and closed-end fund operators and not much else. Obviously, that's a little self-serving, but I do think that in a market environment where returns available to investors who need to meet a funding requirement, right? Pensions, endowments, foundations, they typically need a mid-high single-digit return at the plan level. It is increasingly difficult to get, even a meaningful fraction of that from higher quality fixed income. And to Nancy's point, one does not want to, bet all on public and private equity markets. So I do think that that alpha excess return is very valuable, even though it's only a small part of that. And I think that differentiated return drivers are also an important part of it.
So that wraps up the questions I have for all of y'all, but the audience has some as well. The first is around the U.S. election. We're not going to ask anyone to name or make a prediction, but we are wondering how your firm is planning on handling the volatility that'll come around the election potentially. We're less than 2 months out, and would love to hear around how your firms are thinking about this. So, Terry, if you could start us off.
Sure. As I mentioned, our book and investment strategies are less susceptible to market volatility. It is a part of it, but the idiosyncratic risks that we manage are I think, less susceptible to who is in the White House. I don't want to make any predictions, but I think the market is pretty much priced in whatever candidate will win. Obviously, the tax policies of the Trump administration. Bloomberg put out a piece a couple weeks ago that compared and contrasted the Biden administration versus the Trump administration. And for tax policy, we'll see a potential significant change. But I do think the market, to the extent it will impact what we do, is already capturing that.
Thank you. And Nancy, how is Quadratic thinking about this? Obviously, you guys are quite intertwined with the volatility world. We'd love to get a sense of how you're thinking about the election going forward.
So I think volatility is something that every investor, mostly, especially credit and fixed income investors, they are short vol in their portfolios, and they just don't necessarily know it, especially with mortgages and agencies and structured credit exposure. So what we do at Quadratic is really help investors to own volatility as an asset class. I'll pull out my hat. We don't really care what happens in the election or any outcomes, but we heart volatility. And when you have a strategy that's long vol, it's a diversifier in the portfolios, and that's always a good thing. So we never shy away from volatility. We don't necessarily need it to have good performance. You can see the iVol ETF is up over 11% in 2020, and interest rate volatility, with the exception of March, has been on a straight line down. So we don't need there to be vol to make money, but we definitely love volatility when it happens. And I think investors just need to be prepared. The election is obviously a date that's circled in November on everyone's calendar, but at the same time, there's so many things that happen in markets that investors can't predict. And I think that's when investors really need to have diversifying strategies and to have something in their portfolio that's not going to be correlated to credit spreads and equities. So we have no view about the election, but I think it's just an example of investors need to have diversification, and they need to be prepared for whatever outcome. Like the pandemic is a perfect example. Nobody, probably most people wouldn't have thought that this would have happened. It sounds almost like some kind of crazy science fiction movie, or even monetary policy. If you think about the beginning of 2019, the rate market has priced in 3 full hikes from the Fed. And in 2019, without a pandemic, they actually cut 3 times. So I think it just goes to show that you can't time things, you can't predict outcomes. And even if you could predict outcomes, you wouldn't necessarily know how markets behave as a result of those outcomes. So just be prepared, be diversified, and be positioned in the right asset allocation for whatever outcome might be in the future.
Thank you, Nancy. And now, Craig, how is Corbin thinking about his portfolio in the run-up to the election?
I would echo a lot of the points that Nancy made. If I had told you that, that GDP was going to shrink dramatically this year, unemployment was going to, more than quadruple, and you knew that perfectly, I don't think you would say, hey, the single family home market will boom and the S&P will be up 5. So even if you know what's going to happen in geopolitics now, and this is different from when I started my career 25 years ago. It used to be that you had some reasonable ability to cuff market impact of news or changes in the geopolitical or economic environment. And I think that's become increasingly difficult. So even if you knew what was going to happen, I don't think you can predict with any sort of useful certainty the market impact. So to Nancy's point, I think we try to be diversified by geography. We try to be diversified by asset type. We try to be fairly defensive in our risk betas, right, which are generally available to our investors in much cheaper, more liquid format, so that we can try to deliver, active security selection value add through our end investors. So that's not a very exciting answer to someone asking for, positioning around the election. Hey, we're trading high yield payer options or inflation break evens, all things one could do if you had really high certainty. But I think those are broadly pretty low Sharpe ratio trades, right? Because you need to have a differentiated view away from what the market's pricing and get it right. So for us, I think it's really about trying to construct portfolios that can perform well in a wide range of political and economic environments.
Thank you, Greg. That was really illuminating, and thank you to everyone who answered that question. We'd like to thank everyone for taking time out of your day to view this panel, and like to thank all the panelists for their time and insights. If there's any questions, I think feel free to follow up with the EisnerAmper team, and they can get in contact with one of us. Hopefully we won't have any questions about who will win the election, but we hope you enjoyed the content and enjoyed some of the insights from these three very accomplished panelists. Thank you.
We hope you enjoyed this panel session. The videos of the concurrent sessions will be made available after the event. Please visit the Summit Portal lobby to take our brief industry questionnaire for a chance to win an iPad Pro. At 2:30, please be sure to visit the main stage and click to launch the live fireside chat hosted by our CEO, Charles Weinstein, with Donna Brazil and Karen Hughes. Thank you.